If you had simply held a few great growth companies for the past decade, you could be sitting on life-changing returns. Shopify has delivered roughly 40 times your money, ServiceNow is up well over 10 times, Amazon is up about 8 times, Alphabet is up around 7 times, and these are not lottery tickets. They're businesses that grew revenue at double-digit rates for years, and the market rewarded them for it. Today, I'm breaking down 5 ultra-high growth companies to research right now, plus one honorable mention. You'll learn what actually drives multi-year compounding, what to watch in the numbers, and how to think about valuation so you're not just chasing hype. Stay with me until the end. I'll share a simple checklist I use before buying any high growth stock, the 2 most common mistakes I see new investors make, and 1 practical step you can take today to position your portfolio for the next decade. I'm Chris. I'm not a financial or a tax advisor. This video is for education and entertainment purposes only. Please do your own research and due diligence before investing or doing anything with your personal hard-earned money. If you're someone who wants to take control of your finances and build wealth step by step, you're in the right place. Hit that like button, subscribe to the channel, and let's get into it. Here's the core patterns almost every big winner shares. Long stretches of 20+% revenue growth, improving unit economics, and a long runway of demand. And that's it. The story changes, but the math doesn't. Before the list, 2 quick definitions so we're on the same page. When you hear PE ratio, that's price divided by earnings per share. It's a rough yardstick for how many years of current earnings you're paying for a company. A higher PE can be justified if earnings are growing quickly, but it also raises the bar. And when you hear price to sales, that's market value divided by revenue. For companies reinvesting heavily or not yet highly profitable, price to sales helps you compare how much the market pays for each dollar of revenue. Ultra high growth stocks usually carry above average PEs and price to sales multiples because investors are discounting many years of expansion. That makes them more volatile. Drawdowns of 30% to 60% are normal, even in long-term winners. If that really doesn't fit your risk tolerance, stick with steadier names. And it's good to know yourself here because a 50 or 60% drawdown, even if the long term looks good, might shake you out of the market and cause you to sell at a loss if you're not confident in the investment, the stock, the ETF, or the company. What's one growth stock that you understand really well at the business level and not just the ticker? Drop it in the comments. I really do try to read them all, and I may feature it in a future video. All right, so let's jump in. Let's start with Celsius Holdings. Celsius built an energy drink business by positioning its products around fitness and everyday performance, then plugged into a distribution machine. The turning point was a long-term agreement with PepsiCo in 2022 that included a $550 million investment and gave Pepsi an initial 8.5% stake. That deal put Celsius on trucks and shelves nationwide. Fast forward to late August 2025 and the partnership expanded. Pepsi invested an additional $585 million in newly issued preferred stock. Celsius acquired the Rockstar energy brand in the US and Canada, and Pepsi confirmed it would continue to own Rockstar internationally. Celsius is also now the strategic energy lead with Pepsi in the United States, where Pepsi distributes the Celsius portfolio and the Alani new brand. The result is a much larger product slate under one coordinated go-to-market motion. So why this matters for growth investors is really simple. Distribution scale plus brand momentum can reignite top-line growth. The updated partnership removes bottlenecks, it broadens shelf presence, and adds a mainstream energy brand alongside Celsius's fast-growing core products. Those ingredients can support sustained double-digit revenue growth, better in-store placement, and over time, international expansion via Pepsi's network. What to watch next here? Scan company updates for repeatable same-store sales growth, new retail wins, and early signs of margin discipline while they integrate Rockstar. The risk side is also clear. Energy drink categories can get crowded, and execution missteps show up quickly in scanner data. If Celsius shows how distribution scale fuels beverages, the next company shows how smart brand building plus acquisition can re-accelerate beauty. e.l.f. Beauty is a case study in stacking growth drivers. First, e.l.f. built a value-priced cosmetic brand with massive social reach. Then it expanded into skincare with a 2023 acquisition of Naturium. In 2025, e.l.f. announced a deal to acquire Hailey Bieber's Rhode, moving more deeply into prestige skincare and opening up new retail channels, including Sephora. Rhode's retail debut at Sephora North America was reported at roughly $15 million in first day or first week sales, depending on the outlet, with multiple sources confirming it set a new launch record for a celebrity beauty brand. Regardless of the exact day 1 versus week 1 split, the demand signal was real, and it validates e.l.f.'s thesis that Rhode can scale quicker together under a broader platform. So why does this matter? e.l.f. now has 3 engines under one roof: mass cosmetics, fast-growing skincare, and a prestige brand with significant cultural pull. That mix can drive higher growth for longer than any single line alone. It also lets e.l.f. negotiate better shelf space, leverage cross-brand marketing, and pursue international rollout with more leverage. Some risks to track is integration bandwidth after back-to-back acquisitions, inventory planning around viral drops, and any signs that promotional intensity starts to erode gross margins. Next name on the list is about data. Let's talk about Meta. Meta platforms remain one of the most durable, high-growth machines in tech. As of late September 2025, Instagram reached 3 billion monthly active users, joining Facebook and WhatsApp at a scale that very few platforms on Earth achieve. Threads, or Meta's text-first app integrated with Instagram, has crossed roughly 400 million monthly active users about 2 years after launch. Scale is the raw material that Meta converts into ad revenue and increasingly into commerce and messaging monetization. Here's why this is relevant to the next decade. First is ad performance. Better recommendations keep people engaged, which increases ad impressions and improves conversion for advertisers. Second is on-platform commerce and messaging. WhatsApp business usage continues to grow, and there's still a long runway to monetize messaging globally without hurting the user experience. Third is infrastructure. Meta has been spending aggressively on AI training and inference capacity, plus new data centers. While that compresses free cash flow in the short term, it is directly tied to product improvements and new AI features. The company is investing because at Meta's scale, small performance gains move billions in revenue. The result is a business that can compound at mid-teens to low 20s revenue growth when the macro environment is cooperative. It's not risk-free. Regulation, platform shifts, and competition are very real, but the user base and ad engine give Meta unusual staying power. Meta shows you what happens when software meets distribution, and the next company shows us what happens when silicon catches up to a once-in-a-generation demand wave. Advanced Micro Devices, or AMD. The market knows AMD as the perennial challenger, but over the past few years, it's earned a seat at the front of the AI table. On June 12, 2025, AMD unveiled its Instinct MI350 series, new data center GPUs designed for AI training and inference. Along with updates to its open software stack, ROCm, AMD's own materials point to step function inference gains, while upcoming software releases and its architecture roadmap signals a fast cadence from MI300 to MI350 and beyond. The point isn't any single number. The point is that AMD's hardware and software are advancing quickly enough to win real workloads. The company's momentum has shown up in the results. In the June 2025 quarter, AMD reported year-over-year revenue growth in the 30% range, with particular strength in client, gaming, and a growing data center mix. And all of this even as China headwinds affected some of the shipments. The key is that multiple segments are contributing, which reduces reliance on any one single cycle. A few things to watch here are sustained growth in the data center segment, visibility into MI350 deployments at hyperscalers and leading AI labs, and progress in the software ecosystem so developers can move models across hardware without function. Risks would include aggressive competition, supply constraints, and the inherent lumpy nature of large AI CapEx cycles. The next name is a consumer brand executing a simple playbook at scale. The honorable mention here is Cava, C-A-V-A. Cava is a fast casual restaurant chain built around Mediterranean bowls and pitas. The model's straightforward: strong unit level economics, a menu that travels well for digital orders, and a long runway of new store openings across the US. Why it's only an honorable mention today is valuation. As of late September 2025, estimates put Cava's forward PE around the 90 to 110 range, depending on the source. That's high for any restaurant concept and leaves less room for execution errors. On the flip side, the brand's growth profile has earned that premium so far. If you're researching Cava, focus on the new openings, same-store sales, and restaurant-level margins. A premium multiple can work if those fundamentals keep compounding, but it can punish investors if growth decelerates. Cava shows you the power of simple execution And our last company shows you the power of product breadth in financial services during a tough lending cycle. Let's talk SoFi. SoFi is building a digital financial platform with banking, lending, and investing under one roof. The core bet is that a mobile-first, low-friction experience can win younger customers and then cross-sell them additional products over time. In the June 2025 quarter, SoFi reported GAAP revenue of roughly $855 million, up about 43% year over year, and record adjusted net revenue of about $858 million, up 44%. Members grew to roughly 11.7 million, a 34% increase from a year earlier. Those are not the numbers of a company standing still. What's important is the mix here. SoFi calls them members, but think customers over a lifetime. Acquiring a checking customer today can lead to a savings account next, then a credit card, a personal loan, a mortgage when rates normalize, or an investment account. The more products a member uses, the stickier the relationship becomes and the better the unit economics look over time. The risks here are credit cycles and interest rate volatility. Even with a bank charter, SoFi has to price risk carefully and fund growth responsibly. Things to watch are net interest margins, delinquency trends, and contribution profit by segment. The opportunity is clear, but patience and underwriting discipline definitely matter here. All right, we just covered beverages with distribution scale, beauty with platform scale, a social network with unmatched reach, a chip maker racing ahead in AI, a restaurant growth story, and a digital bank built for cross-selling. Different sectors, same compounding playbook, high growth sustained by real operating advantages. As promised, here's the simple checklist I use before I buy any high growth stock. One is revenue growth. I want a track record or a clear line of sight to 20% plus growth for multiple years, driven by more than just one lever. New customers, higher spend per customer, and new products. If growth is a one-trick pony, it usually slows faster than you expect. Two, distribution or network advantage. This could be retail shelf space, a dominant app with billions of users, or deep relationships with enterprise buyers. Without a distribution edge, competitors catch up. Three is improving unit economics. That means gross margins stable or rising, sales and marketing spending is getting more efficient as the base grows, and evidence that scale drives better profitability. Four, valuation and context. A high PE or high price to sales isn't an automatic no, but the higher the multiple, the more you need confidence in a long runway. I compare today's multiple to a reasonable 3 to 5 year scenario and build in a margin of safety. Five is balance sheet strength. Cash and liquidity buy time, debt adds risk. In a downturn, the companies with clean balance sheets can invest while others can retrace. Some action you can take today is pick one company from this list or another growth name you understand and write a one-page thesis using that checklist. If you can't fill it out with facts, you're not ready to buy it. And if you can, set a price range where you'd be comfortable building a position over time and start small. So here's a deeper question for you. When you think about the next 5 years, where do you see the most durable growth? Is it going to be consumer brands with distribution, software platforms with data, or physical infrastructure for AI and energy? Tell me why in the comments. I really try to read everyone and I'm learning just like the rest of you guys. Two mistakes to avoid with growth stocks. First, mistaking a viral quarter for a durable trend. One big headline or one product launch doesn't equal a moat. I would look for evidence across multiple quarters and multiple products. Second, ignoring valuation and position sizing. Even great companies can be poor investments if you overpay. Try to size your positions so a normal 40% drawdown doesn't force you to sell at the worst time. So here's a recap of the 5 stocks and why they're on the research list today. Celsius, because it expanded partnerships with Pepsi, creates a stronger, more coordinated energy portfolio with broader distribution. That's a textbook setup for sustained revenue growth if execution stays really tight. e.l.f. Beauty, because it's assembling a next-gen beauty house, value cosmetics, fast-moving skincare, and a prestige engine in Rode, with early proof of demand at retail. Meta, because reaching 3 billion users on Instagram and hundreds of millions on Threads gives it unmatched surface area to monetize as AI improves recommendations and messaging. AMD, because its MI350 roadmap and improving software stack position it as a credible alternative in AI compute with financials reflecting multi-segment strength. SoFi, because accelerating revenue, strong member growth, and raised guidance shows the model's working through a tough rate environment, and the cross-sell runway is still in front of them. The honorable mention Cava shows how simple models can scale. Just know what you're paying for and why. If this helps you think more clearly about growth investing, hit that like button, subscribe to the channel, and tune in for more step-by-step wealth building content every week. As always, thanks so much for watching, and I'll see you guys in the next one.